Okay, chapter 20. I did just a quick notes sheet here because otherwise I wouldn't have anything on the screen to show you guys because you don't have any assignments outside your workbook for this chapter, and the assignments that are in the workbook, are pretty self-explanatory. So this is just a quick sheet here to give you a review of the chapter. All right, so accounts payable, oops, I missed the S on there, so sorry about that. Accounts payable is the amount that a business owes, sorry. And so that's the money that is owed to, say, they bought this huge amount of equipment and they have a loan out on it and they still make loan payments, so they still owe that money. Anything like that the company is making payments on or owes to an outside company. Petty cash is different from cash on hand. Petty cash is used for small incidentals, so maybe you would have to go out and buy stamps with it or something like that. Cash on hand is what is used for patients when they are making cash co-payments. So if a patient's co-payment is $20 and let's do the opposite. So if a patient's co-payment is $15 and they give you a $20, you have to give them $5 in cash. That is what cash on hand is for. Petty cash, like I said, is for small incidentals that you would need to purchase for whatever reason around the office. Accounting is what shows the financial position of the company. Companies have to keep track of the money they currently have, the money that they pay out every month, their net worth, or how much the company is worth, how much their equipment is worth, all of those kinds of things. You know, how much money they pay out in employers or employees, paychecks, all of that stuff. So then they have the assets minus their liabilities, which gives them their net worth. So assets are what they own, liabilities are what they owe, and that equals their net worth. So the basic accounting formula shows what the company has minus what the company owes and gives what the company is worth, so the value of the company. Now your accounts receivable ratio is your current accounts receivable balance divided by the average monthly gross production, and that equals the account receivable ratio. So it shows how quickly accounts are being collected. So the from the time the bill goes to the patient, how fast they're getting that bill paid. So the AR balance is the current outstanding amounts that's divided by the average monthly take-in, and that equals the turnaround time for the payment, and their goal is 2 months or less. So their goal should be that they are getting that one bill paid in 2 months or less. So that's the goal for every bill that they send out. That shows them that they don't have a lot of people that are going into collections. It shows them that they don't have real lax rules when it comes to patients, taking a little bit longer than they should on paying their bills, those kinds of things. So a good healthy business would have a AR ratio of 2 months or less. Collection ratios, then you have two different ones. You have a gross collection ratio and you have a net collection ratio. These show how much is being collected. So the higher the percentage, the better. And your net collection should be between 90 and 100%. So gross collection ratio is your total payments divided by your total charges. Your write-offs and your adjustments are not considered in your gross collection ratio. Now in your net collection ratio, you have total payments divided by the total charges minus your write-offs and your adjustments, and that would give you a percentage out of that. And the percentage for that one, the goal is to be between 90 and 100%. That again shows that you have a healthy company. If you're not getting that kind of percent, then you need to relook at your situation and see if you can improve that. Cost ratio is showing the benefit of a particular procedure or service that the company offers. So it's showing them if it's cost effective for them to offer that. There's no sense in having and offering this procedure where you only do one a month and it doesn't pay for itself. The goal for companies or clinics is to obviously make a profit. So if they're not making a profit, they need to figure out either that they need to get rid of it or they need to figure out a way to make it more cost effective. So the total expenses divided by the total number of procedures for the month give you that cost ratio. So it's telling you if that procedure is cost effective. So let's say a clinic offers vasectomies and they only do one a month. Probably not cost effective, probably not a procedure that they're going to offer anymore. So they need to make sure that the demand is there and it's a healthy thing for their business to offer. An income statement then shows the profit and expenses for a given month. It also includes the year-to-date information for a given year. So this is a one-glance thing to look at. Is the company profiting? Is it not profiting? Is it throwing out too much in expenses? All of that. So it's a big statement that shows at a glance all of the going ins and going outs of that company. So it's a good quick look for the companies to give them an idea of the where they're at, I guess. Now your balance sheet shows the company's assets, liabilities, and owner's equity, or the net worth of the owner. So this is the statement of financial position. So this actually says, yes, 100% we are indeed making money from this company, or the opposite, that we're making no money. So that again gives the company a good glance at how that company is doing. Now your income statement holds way more information than your balance sheet does, and your book gives you a really good example of those, and you'll see that your income statement actually covers 2 pages. So there's a lot of information on the income statement that the company plots on that. And then your balance sheet then is just pulling out the more important things to show exactly if that company is making money or losing money. For your assignments, like I said, you don't have any outside of your workbook. You're not doing anything super difficult for the workbook here. You're completing the petty cash form and doing some matching and those kinds of things, so you guys shouldn't have a whole lot of difficulty with that. But as always, if you do have questions, you can just let me know.